going to switch it up a little bit today and discuss the rotation that I've observed over the last several months. Obviously, with Donald Trump being inaugurated as the U.S. president roughly about 2 months ago, there's been a significant shift in equity markets. And really, what we're seeing is a reversal of a lot of the trends that have dominated the market cycle over the last 2 years, and even further extending out to 10 years. Discuss what is happening right now with the US equity market versus the world, and also what is really going on under this phenomenal lack of market breadth that we've been seeing in the US equity market that's unwinding right now. And the number one reason that I like to stock pick is so I can avoid elevated periods of risk in the market the best I can when breadth is low, like it has been the last few years. We're taking a look at our market data dashboard. In terms of US equity indices here, we see our year-to-date numbers. S&P 500, that's my benchmark, as well as the benchmark of many. We see that it is down just over 3 points. The NASDAQ, a little bit more severe than that, close to 6 points down. You see mid, small, and micro cap faring worse. And of course, the industrial heavy Dow Jones only down 1.2%. Stocks are red today, but have been up the last several days. This is very material here. Devil is in the details. So while you see all across the board, all US equity indices trading down on the year, notably only two sectors are down on the year. In fact, many sectors having a very good year, such as energy up 8.4%, healthcare close to 7%, staples 1.4%, so on and so forth. Again, only technology and consumer discretionary are having a down year so far. Let's just take a look at what technology really means. In that view, we're tracking the XLK, the Technology Select Sector SBDR Fund ETF. Obviously, gives you an idea of what we're dealing with. The number one holding at 15%, Apple, 12.5%, Microsoft and Nvidia. Next is Broadcom. While Broadcom is not one of the Mag 7, technically, it is one of the top 10 biggest companies by market cap. So while Broadcom is not typically included in the Magnificent Seven, it might as well be for the purposes of what we're discussing here. So what do we notice here? We notice that the top four companies in this particular ETF, Apple, Microsoft, Nvidia, and Broadcom, that's about 35% of this entire slice of companies here. Well, it just so happens that those top companies are also 4 out of the 10 biggest companies in the S&P 500. But either way, that should give you an idea of what is occurring there. You have pretty much all the biggest companies in our stock market happen to be within this sector. You notice here, while I am not going to be breaking down the contribution returns for you, it's pretty clear to see what's going on. That when we're looking at the S&P, when we're looking at the NASDAQ, and to a lesser extent the Dow Jones, these poor returns are due to a rotation out of technology, whereas most other sectors are doing just fine, if not continuing their bullish momentum. I mean, if we do the same and we look at consumer discretionary here, this other sector ETF, we see Amazon and Tesla, again, making up another 32%. So that gives you an idea. Be sure to check it out if you haven't. Year to date, we're down 40% in Tesla stock. Amazon, to a lesser extent, also has sold off. year to date, from roughly about 10%. So that gives you an idea of what this data says, the message that the data is trying to send us. To me, the message that the data is sending is that we've had this incredible run in mega cap, large tech, US based. Not only have those companies outperformed global markets, they've outperformed many of these sectors. If I just pick energy is the best performing sector out of all of the ones shown here, let's take a look at this ETF. Again, our S&P 500 is up about 9% over 1 year. This has been flat. It's done very well over 5 years coming out of negative oil prices in COVID. But you see here over 10 years, only up 20%. You see here that over a 10-year time frame, the S&P 500 has doubled this ETF, even just in total return, far surpassed in price return. Okay. But here's the top weighting of this. ExxonMobil, Chevron, ConocoPhillips. Yeah, you see here up 7%. As to why energy is performing so well, simple example here. The XLE, this ETF, the selection of companies, this basket just drastically underperformed the S&P 500. The S&P 500 being driven by being very top heavy, concentrated in those large cap companies. Okay. And so what we're seeing is a rotation out of those companies into other sectors here. Staples is a sector that I really like, that I've made some picks in the last few years. We see how, comparatively lacking in volatility Staples is. But you see over this time frame, what is the hallmark of Staples? Outperforming in bear markets, underperforming in bull markets, and has seen some of this rotation. You can see it in the price action where Staples has gotten bid up, whereas the S&P 500 is sold off. So I've long been positioning, at least over the last year, if not 2 years, while the markets have really been hot and top heavy, I've been allocating a majority of my portfolio to more value oriented investments such as energy and staples, utilities, industrials. What we're seeing, and the intention behind that is to position for an event like what we're seeing now without necessarily knowing the catalyst. Of course, the catalyst is tariff scares, but you also have this other phenomenon that's been driving our market, the AI capex boom. Of course, that's sent stocks like Nvidia and Broadcom parabolic over the last several years. While I don't see that trend reverting anytime soon, what we do see is with the proliferation of Chinese LLM models like the DeepSeek, I want to say it was like Alibaba, one of the big Chinese tech giants, released an LLM a few days ago at a significantly lower cost. If you know what I'm talking about, comment below just to check me on that. But basically, there's been over the last several months, there's been several newsworthy events that have really created a juxtaposition between the U.S. AI capex boom and then China really flexing some technological muscle and delivering a AI LLM product that is arguably better because it's much more cost effective. They're undercutting American AI, such as OpenAI and all that. So that's created volatility in the tech names, but it's also created uncertainty and doubt around the capex required to build that out. So that's also led to some of the sell-off we're seeing there. You see here that the world stock market is up, including the US. The world ex-US up double digits. Developed markets, EAFE, which is global ex-US Canada. Okay, so that gives you an idea. ASML SAP, Nestle. So Europe has had a good run. Europe has had a really good run year to date. Of course, we have the everything newsworthy about the Ukraine war peace negotiation. That's really sent European defense stocks running hot, particularly German defense stocks. You see here the German stock market already up 22%. China, the biggest beneficiary of what's going on, given their tech scene, and of course China has had very poor stock market performance the last several years, and so there's somewhat of a reversion. So basically, United States stocks have ran really hot, demonstrated 2 years in a row of 20 plus percent gains, very strong return in performance, and we're seeing kind of a expectation change in a rotation out of that. If you're heavily positioned in technology stocks, then you're certainly feeling the pain. However, if you've been spending the time investing in more value oriented names like I have, then you might happen to still be up on the year, which I am. Again, let's take a look at the consumer staples. Some of our top picks here. Costco, we've got a position in that. Philip Morris International, that's the number one holding in my portfolio. Up over 20% year to date, done phenomenally well. PepsiCo is another holding. Altria, not hot on Altria, but has done well this year. Mondelez International, no position there, but we do have a position in Hershey. So that gives you an idea. Let me just pick one of these. Which one should I pick? Costco's not a good example because Costco has outperformed. Let me just show PepsiCo. Now, PepsiCo, I have not made a video on PepsiCo, but I should. It's one that I have in the portfolio in a small position. But what I want to point out is you see here, of course, this period here is the most recent bear market in the S&P 500. Okay. And no, I'm not including what's going on now as a bear market, even though I think technically we did reach correction territory. Pepsi, as it should, outperforms in that type of environment, but has really just sold off while the AI mania has bloomed and blossomed into further and further gains. Late February is kind of when the current sell-off in the broader market stopped. S&P starts going down. Pepsi starts bidding up, right? That gives you an idea of where some of that money's going. It's rotating into stocks like Pepsi that have done very poorly the last 2 years. So if you've been accumulating in those more value oriented sectors, then perhaps you aren't feeling too much pain. Another good example of this is one of our favorites that we cover on the channel, Hershey. Obviously, Hershey's done very poorly. One thing that I want to point out is that Pepsi and Hershey are very highly correlated. You see how they kind of have similar characteristics. Hershey is more volatile. You see how it outperforms to the up and downside. It appears in either direction. Okay. We have a much larger position in Hershey than Pepsi. For this reason, we feel that it has a stronger beta than Pepsi and will surprise to the upside if the sector rips. In fact, do we see that over the last several months? Year to date, both of these stocks have sold off, not quite as much as the S&P. And we see at one point Hershey all the way outperforming by 10%. So Hershey's been very volatile because of challenges that they've been facing. We see again here within the last month, the S&P has just sold off. Meanwhile, these two staple picks have traded up. Another one that we like is McCormick, one that we've covered on the channel. McCormick continues to outperform all of these names and be a very, very strong performer. So all I'm trying to highlight here, there are a million examples like this in the investable universe to take a look at. All I'm trying to demonstrate is that I've been positioning my portfolio for a rotation out of growth into value. That has somewhat happened. Now, what is more meaningfully happening right now is this geopolitical rotation out of the US markets into other markets. I see nothing wrong with that. I think it's completely healthy for repositioning to take place. The majority of my portfolio is US equities and will continue to be so. I see no reason to shift that outlook. However, if you had done what I considered doing but did not ultimately pull the trigger on, like rotating into Chinese tech for several quarters ago, you would be experiencing phenomenal year to date performance. So I think what the outlook is, and where I'll leave this video with today, is that the S&P selling off a couple points, it's not that bad. If we did have a down year in the US stock market this year, I think that'd be great. Just from the standpoint of I'm in the accumulation phase and looking to acquire more. I think another thing that I really like about what's going on is it is highlighting how American exceptionalism is an outlook, it's a strategy, but it's not the only way to go about it. I think what we're seeing is with the shifts that are occurring in the world, that there's a world full of opportunities in the markets. And I'm excited for that. So if you're excited for it too, just let me know below, comment. We see here bonds have done well year to date as well, even bonds greater than the US market. I haven't discussed bonds at all on this channel, but have accumulated them over the last quarter in anticipation of, modest performance gains. So anyways, that's where I'm going to leave it. And very brief video, but hopefully you found this interesting. And I'm planning on doing more of these top-down level discussions, we'll call them, instead of just focusing and fixating on one particular company. So if you like that, be sure to let me know, give me feedback, like the video, consider subscribing to the channel. Anyways, that'll be it for today. I'm going to sign off, but I will see you tomorrow. All right, thank you.